going on, everybody? So I have a gold breakdown here as well. I am in replay mode. I like to show you guys what I was looking at when I seen this and how it played out, where I expected a rejection level to come at. So we had gold trending upwards, and then they put the brakes on after clearing out this high here and showed willingness to trade down. So we had this massive move to the downside, and under this low here is sell side liquidity. So at 1694.790 is the previous low before this major up move here. So people will be willing to short this market once it breaks its low. We have the breakout traders with the sell stops. We have the traders who trade retail who are seeing this move happen, clearing this low. So they're like, okay, clear this significant low here. Now we should see lower prices. Well, as an institutional trader, we know that we pair our buy orders with sell orders. So in order for us to be able to buy, they have to sell to somebody. That's how it works at the big level. In order for them to buy the market, they have to have willing sell participants. So under this low here, they grabbed the sell side liquidity, as example in this yellow box here. They rated that sell side liquidity and came right back in with a bullish candle. I seen this and thought to myself, okay, well, under this major low is the sell side liquidity. Now, if I'm going to take this market to the upside, what am I looking to be filled in here? Well, I grabbed the sell side liquidity, and we have this slight fair value gap between this wick and this wick here. And we also have this 3 candlestick pattern order block here. So I know that they will most likely take these lows again. They will clear out this low here, but before they do that, they're going to take some of that sell side liquidity and they're going to fill in this fair value gap and retest this order block here. This is your algo. Your algo knows that the fair value gap is here, the order block is here, and these are areas where that needs to be retouched. So I saw this and I expected a move up at 177 pips. I targeted just under the order block here. So I didn't want to take the whole cheese. I knew that most likely this will be filled in and this order block will be tested. You don't always have to go for the home run. You don't need those extra 10, 15, 20, sometimes 50 pips. You can take what the market gives you. Take what you know the market will be. So 177 pips is what I took here. And this is how it played out. So this is where I entered here. And after grabbing that sell side liquidity and retesting into this area here, I knew I was safe. They're gonna go to the upside. They're not gonna come back down. This is like if someone took your wallet while you were standing there, they're not gonna run right back to you and give you the chance to get your wallet back. They're gonna run away from that sell side liquidity. The target was hit. Target was hit here. So they also gave another entry here at 2 a.m. your kill zone hour. Between 2 and 5 a.m. is your kill zone hours for London. And they gave another entry here. Now usually I wouldn't trade this pair in London because it's a USD based pair, but I trade the setup, not the time. I also entered at an awkward time. My original entry was around like 4:30 in the afternoon. Normally I don't trade at that, but I saw what happened with the run on liquidity. And then I saw them come back down in this candle here, and I had a feeling that they weren't going to come back down to let anybody out who sold down here. They were going to come back to our institutional point for our order block. They filled it in, so it's 177 pip TP smashed with very, very little drawdown. So if I entered here, let me zoom in a little bit, the drawdown was 94, which is only 9.4 pips, which is 9 pips. So on gold, the pips are a little different. And that was a 9 pip drawdown, entering at 4 p.m., 4:30 p.m. Weird time, but I traded the setup, not the time. They don't always have to move within our kill zone hours. And they did come back down to our entry for London to give us another one. So I had a webinar for my mentorship, and we had just watched this play out. And I told them that these lows here would eventually be violated again, and you had these equal lows here as well. So for NFP, I called dollar to go slightly bullish, EU to give a slight rejection at the daily order block, and then gold to sell off as well. And so this is how that played out. We expected some rejection into this order block here. So this three candlestick right here, 1, 2, 3, is your price block. It's where the algorithm basically put the brakes on buying, and they sold short. So this is an institutional price point. After the fair value gap was filled, with just a slight retracement back to these points to fill in the fair value gap into the order block here, before making their downside to 1685 was the equal lows. So as we watch this play out, right into our order block here, and then we have that down move that we anticipated. Basically just a grab on liquidity, fill in the market to equilibrium. Everything was delivered efficiently now. Order blocks were traded, and right to those equal lows. Those equal lows cleared, and we had gold push to these lows here as well. So from that price block, if you would have got in on the lower end, it was a 487 pip move after catching 177 to the upside. So that was a market breakdown on gold. Nothing too critical, nothing too crazy. Just a few institutional concepts used in this. This happens over and over again. You'll see it on every pair. This is how IPTA will move the market based off liquidity. So as an institutional trader, you see this crazy down move, and they grab sell side liquidity. You can expect a retracement back to that fair value gap or the order block or the institutional reference point, then for more downside. So that was the market breakdown on gold. Hope you guys enjoyed.